Hello and welcome to the SIA Wealth Management Advisor Update for February of 2025. My name is Colin Szynski, Portfolio Manager. In this month's update, we're going to look at current economic and market trends that we're seeing out there at the moment. We'll do an update and performance on our portfolios. We'll also do a peer comparison, look at risk-adjusted metrics for three portfolios on which we are sub-advisors: the BMO Tactical Global Equity ETF Fund, the BMO Tactical Global Asset Allocation ETF Fund, and the BMO SIA Focused North American Equity Fund. We'll start off as we do often with our in our webinars with a look at the SIA Charts Equity Action Call. This is a measure of the relative performance of equity asset classes versus non-equity asset classes such as cash, commodities, and bonds. It gives us an idea of capital flows and where the larger money is moving into. And as has been the case since late 2023, equity action call is in the green favored zone. This means that equities have been outperforming and have been receiving capital relative to other asset classes, and that continues to be the case. And because of that, we remain fully invested in all of our portfolios. The macro focus lately is we've seen that earnings season had been a focus for the last few weeks, but earnings season's now winding down, and the focus has turned back to tariffs and trade wars. The potential for new U.S. tariffs with key trade partners, possible retaliation from the same partners, continues to have an impact on investor sentiment day to day. Something else to watch for is inflation has started to pick up again in the particularly in the United States, but also in Canada, reducing the chances of additional U.S. interest rate cuts. And the economic data has been somewhat mixed lately when we look at things like employment and retail sales and more as we move through February. Looking at world equity markets year to date, basically the market's off to a pretty strong start this year. Europe has done well, North America has done well. Pretty much everything is doing well and positive, with the exception of India and a couple of countries in Southeast Asia. Other than that, it's been a positive start to the year for stocks, and we've seen that in the equity action call as well. Looking at our sector scopes, which is looks at 31 industry groups across the spectrum of the market, and it looks at what percentage of these stocks are on bullish signals or in positive trends at the moment. And what we can see is it's pretty neutral right now. Everything is clustered around the middle. It's not way out at the right end, which would be very positive, but also potentially overbought. It's not way out at the left end where it's very negative or potentially oversold. We're just kind of everything's in the middle, which is neutral to moderately positive overall. Some of the stronger stocks sectors we're seeing at the moment are in the technology momentum area, software, internet. We're also seeing financials like insurance and banks doing well, and metals. Metals have benefited from recent gains in the gold price. On the left-hand side, among the weaker sectors, we're seeing things that are exposed to trade wars, transportation, manufacturing, autos. We're also seeing the construction, also some of the sectors being potentially targeted by Robert F. Kennedy and the Make America Healthy movement. Again, food, tobacco, drugs are among the weaker sectors at the moment. In terms of seasonality, also shows we got off to a very strong start to the year. The green bars are 2025, the red bars are 2024, and the blue bars are the long-term average. So extremely strong January to start the year. February has been negative. That's not to be completely unexpected given the strength of January. Markets are kind of due for a bit of a pause or even a moderate correction here. We are moving, the next 2 months remain historically positive for equities through March, April, and then May to October, you get into the choppier time of the year for global markets. Looking at asset class performance, the U.S. versus the world, the black line is the TSX index for Canada. The orange line is the S&P 500 representing the United States. We can see that the U.S. continues to outperform everything, but also, though, that the strongest performance of the U.S. was kind of November to December of last year, and this year it's creeping up, but at a slower pace. On the other hand, we've seen the purple line is international markets. We've seen a big catch up in international markets over the last few weeks, so that's quite significant. Bonds, meanwhile, have not really done much. They're just kind of trending sideways and underperforming in an environment where Treasury yields have been neutral to positive. Looking at the relative performance of currencies has been interesting. The black line here is gold, and it's been outperforming the paper currencies. And in particular, here we looked at the Canadian dollar and the Mexican peso, which are potentially impacted by U.S. tariffs and the risk of a trade war. And yes, they've come down, particularly in the weeks following the U.S. election when the rhetoric started to ramp up. But lately, they've kind of leveled off a little bit, as though the market's kind of now priced in the impact, at least for the time being. Interestingly enough, the green line, which is the Japanese yen, has started to pick up. Similar to we've seen gains in recent gains in gold. The yen, since the Bank of Japan started raising interest rates and went back to positive interest rates, has started to resume its traditional role as a haven for capital in troubled times. Not to the extent that gold still does, but that relationship is starting to resume again, having been broken for a couple of years. On the other hand, we looked at I look at gold, but I also like to look at cryptocurrencies, and the reason for me is that to me, cryptos are a an indicator of not just risk tolerance but risk appetite. If when people are looking for are seeking returns and willing to take on risk, cryptos is one place that people go. They're out at the margins of potentially high return but potentially high risk. They tend to do well when investors are seeking risk or are seeking growth, and not so well when investors pull back in and get risk averse. So what we saw with cryptos was an explosive rally following the U.S. election. This is because the Trump administration is seen as being friendlier to cryptos than the Democrats were. But following this rally, we've actually seen Bitcoin level off over the last couple of months. Meanwhile, gold has been quietly picking up again, as we've seen issues in the gold market with gold getting apparently repatriated back to the U.S. and generally a higher political risk and volatility out there. I'm going to go now through the major sectors in the equity market. I basically take the 11 level 1 sectors and split them into 5 groups. In each one of these slides, the black line is the S&P 500, gives you a sense of the overall market. Starting with the interest rate sensitive sectors, we can see financials have been very, very strong since November following the election, a sign probably representing that people are expecting the U.S. economy to do well under the new administration. Utilities have just kind of been steady. Real estate had underperformed, but has started to bounce back more recently. Looking at resource sectors, we've split this into 4 here. We're looking at mining related sectors. First, the purple line is the TSX Global Gold Index, which had underperformed following the election as cryptos took off and gold went down. And then since the turn of the year, explosive rally as gold has rallied as well. The orange line is base metals. They've kind of generally been trending downward for the last number of months. The green is U.S. materials have underperformed. The materials sector in the U.S. is a little different from Canada. The U.S. materials is a hodgepodge of chemical companies and steel producers and aggregate companies and all kinds of different things that are in there. It's not just miners. So that's something that's why its performance can be quite different from the Canadian mining indices. And then energy is just kind of going nowhere for the last year, just like the price of oil is the same 6 months anyways. And now moving on to the defensive sectors, we can see defensive sectors since the election have been underperforming, and I talked about that in the sector scopes. But staples have been kind of drifting down. Drugs have been hit even harder. They kind of tried to bounce back, and now they're kind of rolling over again. So this is an area that has definitely struggled, not just because investors are confident, but also some of the companies in this sector may see significant regulatory changes coming their way. Looking at the cyclical groups, I've taken the 2 main ones being consumer discretionaries and industrials. I also added in the transports. And the reason for the transports is because that's another area that could potentially struggle if we do get a more serious tariff and trade war gets underway. So, and that's why actually the transports have actually been the weakest performing of these three groups. The industrials have kind of been in line with the market. And interestingly enough, the consumer discretionaries have done quite well, very much outperformed the market in the last few months, likely a sense that the U.S. economy may do well, and that could be beneficial for consumer stocks. What's interesting about the discretionaries is they've actually done well, despite the fact that the auto sector is in here, and the auto sector is exposed to tariffs and trade issues, and yet this area has continued to actually do very well relative to the market and other sectors. The momentum groups have been split since in the last few months. The communication sector, which is streaming companies, social media companies in particular, has done extremely well, very much outperformed the market. Where the technology has just kind of been positive, but basically in line with the market. Tech is not the engine of the market that it was this time a year ago. It's changed to consumer discretionary as well as communications. We're going to shift focus now from the overall market to the performance of the portfolios that we manage. So the first one we'll look at is the BMO SIA Focused North American Equity Fund. And this is a portfolio of 15 North American stocks that has a tactical focus and concentrated exposure to large cap names. So as we can see here, it consists of 15 stocks that are equal weighted across a wide variety of spectrums. At this point in time, all the holdings in the portfolio were positive at the end of January, with the exception of Bank of New York Mellon, which was down slightly. It was only 1 day of performance for Bank of New York Mellon. It was bought right at the end of January, so it hasn't really had time to show a trend one way or the other. Portfolio continues to hold Netflix, which it had bought in December of 2023. And in that time, a year and 3 months, it's up 131%. So it's done quite well. We do have a number of other holdings that are up in the 20 to 30% range. In terms of the geographic split, this portfolio is split approximately 66% to U.S. equities, 33% to Canadian equities. Looking at the sector breakdown, it's about 33% financials, 19.8% consumer staples, and 13.2% materials at the moment. In January, it returned almost 7.5%. For 3 months, 14.1%. 6 months, 19.1%, and over 1 year, 36.25%. Compared to its peers, this ZFN ETF has done extremely well. It has been top decile performance across the board, 1 month, 3 month, 1 year, 3 year, 5 year. And if we look at the 1 month and the 3 month, fourth percentile, 3 years, fourth percentile. This is a fund that's done extremely well over time relative to its peers. If we look at the risk and return metrics, it's showing a high return relative to its category average risk. So if we look particularly at alpha positive 6.0 versus category negative 4.9, a huge difference there. Big difference in beta as well, 0.47, significantly better than the category at 0.84. Sharp ratio 1.02, considerably better than category of 0.43, and doing this with lower risk as well. Standard deviation 11.6%, category 14.0%, higher than category returns average risk. In terms of then, a lot of what's driving this is the downside capture. Downside capture of only 30% versus the category at 98%. The upside capture is slightly below the category 66 versus 74. Another area, though, of significant, where it's significantly better is maximum drawdown. For the fund, it's negative 8.6%. For the category, negative 16.6%. So this is a fund that delivers positive returns in positive markets and manages risks through difficult or negative markets. We'll move now to the BMO Tactical Global Equity ETF Fund. This is for advisors who are looking for global exposure with the protection of moving to cash during volatile periods. This is primarily invested in global equities with the ability for adapting to market trends. This portfolio is divided up among 25% is a 5 stock portfolio that's 5% each. There's 4 sector ETFs at 8.75% each, and there's 3 broad-based ETFs at 13% each. Looking at the sectors based on this, we see the highest exposure is in financials, followed by technology, industrials, and communications, and also some higher weightings to energy and consumer discretionary. Geographically, this is 94% US equities, 5% Canadian equities. Looking at the returns in January, this fund returned 5.75%, 7.4% over 3 months, 10.3% over 6 months, and just above 25% for the last year. Relative to its sector, and in this case, it's the tactical balance category, is again consistently a top decile and in a lot of cases, top percentile performer. Top percentile for January, top decile for 3 months, top percentile for 1 year, second percentile for 3 years, sixth percentile for 5 years. Very strong performance relative to its peers. We look at the returns on this one. It is high return relative to its category, a little bit higher risk relative to its category as well. But still, alpha very positive, 4.8 versus category negative 1.5. Beta of 0.66 is better than category of 0.91. Sharpe ratio much stronger, 0.68 versus the category of 0.05. Standard deviation, though, is a little bit higher for this one, 9.8% versus the category of 8.5%. Looking at the risk return measures here, in particular the capture ratios, upside capture 96% better than category of 86%. Downside capture also better, 55% versus category of 96%. Once again, better than category maximum drawdown because it manages risk through volatile times. Negative 7.8% max drawdown, categories at negative 12.5%. The final portfolio we'll look at here today is the BMO Tactical Global Asset Allocation ETF Fund. This is more of a balanced portfolio, ideal for advisors looking for balanced growth and risk protection through tactical allocation across equities, bonds, and cash. So this portfolio has an equity component that's identical to the Tactical Global Equity Fund, and that's 60% of the portfolio. 40% of the portfolio is a fixed income sleeve. And in terms of returns, it's consistently, for the most part, a top quartile performer. 6th percentile for January, 15th percentile for the 3 months, 16th percentile for 1 year, 9th percentile top decile for 3 years. And this delivers higher return versus category at less risk than the category. Alpha is a respectable positive 2.62 versus category negative 1.50. Beta 0.61 versus category 0.91, so that's better again. Sharpe ratio much better than category, 0.6 versus category 0.05. Standard deviation also better than category, 7.2% versus 8.5%. And we can see here we're up in the fund is up in the left quadrant of this chart here, higher than benchmark returns, lower than benchmark risk. And where it gets it here, the upside capture is in line with the category, 81 versus 86. Downside capture substantially better, 52% versus 96%. That's like half. So that's a huge difference for this portfolio, and helps to explain that risk management helps to drive returns. And that's important. We want to make money, but we don't want to give it all back in the bad times either. We want to protect our capital in the volatile times and make money in the good times. And the drawdown, max drawdown, 8.9% versus for the fund versus category negative 12.5%. Looking ahead, overall, the North American economy continues to be robust. There are political event risks, both positive and negative, that could potentially impact the markets. But for the moment, the equity markets keep right on climbing the wall of worry. The Bank of Canada remains dovish. The Fed, however, is neutral to hawkish, and inflation is starting to pick up. something to watch for in the coming months. We just started to see a couple of companies mention it at the end of earnings season, is the potential impact of a higher US dollar on US corporate earnings. That could become a negative issue for the market going forward. A higher US dollar built on the tariffs and trade area and relative safety of the US compared to other countries is in some ways a beneficial, but at the same time, it drives up the U.S. dollar. That's a negative for U.S. multinationals. So a higher U.S. dollar favors domestically focused companies in the States, but it's not so good for the big multinationals. SIY wealth indicators remain positive. However, as risk managers, we continue to monitor all the time for changes in sentiment, and we are ready to make plans to make tactical changes as needed. We have plans for the good times. We have plans for the bad times. We have plans for every time in the market. We're always looking for how can we manage risk, and at the same time, how can we take advantage of opportunities that are out there. I'll wrap up with our disclaimer slide here, as I say, the part compliance, road, and legal, and we'll wrap up here. This concludes my my comments for this month on the markets and our portfolios, and we look forward to joining you again soon.